Hey everyone, this is Mike Kramer of Ma Capital. Today is Tuesday, November 12th, and it's around 4:30 New York time. So things are starting to get a little bit interesting here in the markets. We're going to take a look at those in a minute. But let's start off with some of the upcoming data. Tomorrow we're going to get CPI. Here in the US, we're looking for 0.2%. That's expected to come in line with last month. CPI, ex food and energy, expected to rise by 0.3%, in line with last month. Year over year, expected to come in at 2.6, up from 2.4. Core is expected to remain flat at 3.3%. Just one thing to note, CPI swaps for tomorrow are suggesting that the headline CPI comes in at 0.27%. That means it would round up to a 0.3 number. So watch for a potentially hotter than expected CPI report on the headline tomorrow morning. Then on Thursday, we're going to get PPI. That's expected to come in at 0.2%, hotter than last month's reading. Initial jobless claims expected to come back down to 220,000, in line with last month, while continuing claims seen to 1.87 million from 1.89 million. Retail sales come Friday on the 15th. We're looking for 0.3%, down from 0.4, and the control group, we're looking for 0.3, down from 0.7. Also, we're getting import and export prices on that morning as well. And now that we've been a full week removed from the Trump victory, we're starting to see some market impacts really starting to take fold, and they're really very clear and present when you start looking at currencies, and they're also very clear and present when you start looking at interest rates. We don't normally focus on interest rates, but I thought it was just really important to start off with the movement we've been seeing in the 10-year rate, specifically because tomorrow we're also getting that CPI report. Remember, CPI swaps are pricing in a hotter than expected number. So it is possible that we could see the 10-year rate break out maybe at some point this week, potentially eclipsing this 4.45% number and starting to move up towards 4.75%. Now, this is obviously going to have very big impacts and ramifications for currencies, specifically the euro, which right now is really sitting on this support level at 106. Now, we had talked about this potentially coming down to this level. We're now there. And so it's really going to be critical to see what happens now over the next couple of days. Clearly, we are outside the lower Bollinger Band at this point, which suggests maybe we're slightly oversold. The RSI isn't quite at 30, but it's getting there, which suggests that, again, we're maybe in a spot where we could see a little bit further downside, maybe a little consolidation around this 106 region. But if we were to get a break that's decisively below this 106 area, I think that's going to set up a return to this 104 area. And to some degree, this is going to be largely dependent upon where rates go. Higher rates here in the U.S. simply are going to imply a stronger dollar. And you're seeing the same thing happening with the British pound breaking below the 128 level. Again, RSI getting close to 30, but still not oversold yet. Clearly on the Bollinger Band, though, we are below the lower Bollinger Band level, which also suggests maybe we see some consolidation around this 127 region. But I think we have to remember that we're probably looking at further downside, maybe below 127, maybe into this 126.30 region, which has been an area of support in the past. We're also seeing the Japanese yen continuing to weaken. Right now, it looks like we're trying to get above this 155 area. Clearly, there's a pathway open to around 156. We are starting to see the RSI rolling over a little bit, but again, for the most part, it looks like there's still further room to go here in the Japanese yen versus the dollar. And really, for the most part, everything is trading with rates. Here's your 10-year rate. Here's your Japanese yen US dollar cross. So, I mean, higher rates here in the US would suggest, a weaker Japanese yen. It's really the same story when you look at the euro. All you got to do is invert it, and there's your relationship. It's pretty much right there. So again, higher rates here in the U.S. are going to mean, stronger U.S. dollar. There really doesn't seem to be any way to avoid that at this point, and that's having big impacts on things like copper. Copper prices now are a big level of support around this 415 area. Clearly, we still have further room here, not anywhere close to being oversold, still at 38. We are a little bit below the lower Bollinger Band, but that doesn't really mean that we can't go lower. There's a potential here that maybe we drop to around 404 to 405 on copper prices. at least here in the short term. Maybe you'd be looking for some resistance around the 430 level if you were to get a CPI that might disappoint. It's also the same story for gold. Here you can see your two big uptrends. It looks like a bump and run pattern. We broke the first uptrend, and now we're testing the secondary uptrend at 2600. A break of this uptrend leads to a move down to around 2500. Still plenty of room to go when we're looking at these Bollinger Bands and when we're looking at the RSI. So it certainly looks like copper, gold certainly could be big losers here if we continue to see rates continue to move higher and the dollar strengthen. Same thing with oil. We're coming back down and testing the $66.50 area. This is the big area of support. If that region breaks, we're probably talking about moving into the upper 50s. So again, CPI tomorrow comes at a really critical time. You get higher rates after tomorrow's report, you get a stronger dollar, hard assets are going to really struggle. If CPI comes in weaker, you're going to be looking for the exact opposite. Weaker dollar, lower rates, hard assets should go higher. We're currently also seeing this really spilling into equity markets as well. Here's your DAX. DAX isn't doing well, Euro's not doing well. In the past, the two have had a relationship with one another, although that's separated. More recently, here you can clearly see weaker Euro led to weaker DAX, stronger Euro led to stronger DAX. Then the Euro kind of just went sideways for a while. The DAX was able to rally, but for the most part, if we continue to see the DAX, if we continue to see the Euro weakening, that's probably going to mean that you're going to see the DAX really also continue to struggle, because a lot of the DAX's problems have just recently started, especially with the Euro breaking down. So right now, the big level of support that really must hold, that this 18,870 level. If this region breaks, we're talking about a potential move down to 18,300 and then potentially back to the August lows. It's also the same setup when you look at the Stocks 50, although this actually looks a little bit weaker. Again, this also kind of has an overlay with the Euro as well that goes back. So not really surprising to see that the Stocks 50 is struggling with the Euro moving down. So again, this is a big level of support in here at this region around 4750. Break of support potentially sets up this return to the August 5th lows. Here you can see the rising wedge clearly been bearish, so a return to this region certainly not out of the question. UK FTSE also struggling lately, not really surprising considering you're seeing metals, copper really not acting very well. Remember, we've talked about this in the past, the relationship between the FTSE and copper prices certainly still in effect. Lower copper prices clearly not going to be a positive for the FTSE. That means higher rates in the U.S., stronger U.S. dollar, not going to be favorable for the FTSE. And again, we're kind of looking at this region of support in here around 8,000, where if we break 8,000, you're talking about taking out the August lows, and you're talking about potentially moving back into this 7,900 area, potentially even into this 7,800 area. When we swing over to the U.S. markets have really been sort of immune at this point to what's happening in rates and the dollar, although I'm not really certain that's going to be able to persist for much longer. Here you can see your big rising wedge. This is the upper end of that rising wedge. You notice we got right up to it, and that's where we stopped going higher. So for right now, this is your resistance level. This is also where you're at the upper end of the Bollinger Band. So this upper Bollinger Band is serving as resistance. If you're able to break out and clear this area of resistance, well, then sky's the limits, because there's really not much to say that there's not really any resistance above here, since that would be all-time highs. But clearly, in the meantime, if for some reason we continue to see rates and the rates move higher, dollar strengthen, we're talking about the potential to start seeing this gap get filled from the election. And that certainly opens the doorway to potentially breaking the rising wedge and potentially setting up a test of this lower Bollinger Band. So that's something that we really need to be mindful of. It's really the same story with the SPX. Here you can see, again, the uptrend that's in place. Tested it a couple of times, and here we are again testing it. So again, here's your big election move. We gapped over a whole bunch of stuff. clearly what looked like a clear breakout when you're considering you're breaking over the 10-day exponential, the 20-day simple, a big level of resistance, and then all of a sudden you kind of stall out right in here. Again, this could just be a simple stall out, breakout tomorrow, gap over it, move up. Sky's the limits again, but it's going to largely depend on where rates are going, because certainly when you look at European markets, they don't look very strong. And you can really make the same case for the Asian markets, with the Kospi not really looking very good, nor looking at the Hang Seng not looking very good. So certainly equity markets globally don't look very good. I'm not really certain that U.S. markets are going to continue to be into a world of their own. That only tends to last so long. It's also the same story for the Dow. The Dow obviously also having a very big move up. Here you can see if we extend this trend line out, that's exactly where we stopped rising. So again, this is your big level of resistance. Here's your upper Bollinger Band. Here's your RSI. Support first comes around the 10-day exponential around 4330. Then we're talking about 4200. And then we're talking about maybe coming back down to the pre-election levels. So I think ultimately speaking, we're at a spot where, rates are going to really drive things from here. If the dollar continues to strengthen the way it's been strengthening versus many of these other currencies, that's going to create potential headwinds for equities globally, for hard assets globally, and for U.S. equities at some point. That probably all starts tomorrow with the CPI report. CPI report followed by PPI. Analysts are going to get a very good sense of where the PCE is going to be at the end of the month. That's personal consumption expenditure. That's the Fed's favored inflation gauge. That's going to probably largely determine whether or not the Fed's going to go in December with a rate cut. And if there isn't a rate cut, that's going to probably cause more dollar strength. So right now, where rates go are going to largely determine where everything else sets up. So I think you got to be really careful until you get through that CPI report, and maybe even the PPI report, and maybe even retail sales on Friday, because until you get through all three of those data points, you're not really going to have a clear handle on what the Fed is likely to do. So that's really all I have for you today. I hope you have a great rest of your week, and we'll see you next. Bye.